Why Rockefeller's 1913 banking blueprint led J.P. Morgan to corner 750 oz of silver. What if I told you that the fate of a precious metal, the lives of countless individuals, and the future of modern finance were all shaped by a single man's vision? A vision so powerful, it influenced a financial empire for decades? And what if this blueprint wasn't just about wealth, but the strategic manipulation of markets and entire industries? But there's something about this story that's never been told. What happened when J.P. Morgan decided to go after silver? What price did the world pay for their ambition? Hello, and welcome to Wild East Stories, where we uncover the untold, uncover the hidden truths of history that shaped our world today. I'm Marcus, broadcasting from my quiet corner of the world, far from the hustle and bustle, here to walk you through an incredible story that could change the way you view modern finance forever. But before we dive into the details, a quick reminder. If you're interested in exploring more stories like this, make sure to hit that subscribe button. I know, you might think, what's the hurry? Well, think of it like this. If you're not subscribed, you might miss out on the most crucial stories, and I can guarantee you don't want to miss this one. Trust me. And hey, let me know in the comments where you're watching from. Whether you're tuning in from New York, Mumbai, or somewhere in between, I want to hear your thoughts. In the early days of the 20th century, few individuals had the power to influence global economies as John D. Rockefeller did. His name was synonymous with wealth, control, and the kind of business strategies that could make or break industries. But Rockefeller's power wasn't just built on oil. It was built on a financial system he helped create, one that would ripple through generations to come. The rise of John D. Rockefeller. Rockefeller's story began long before he became known as the richest man in the world. His journey was shaped by an understanding of markets, business consolidation, and the hidden power behind industry. At a young age, Rockefeller recognized a fundamental truth. Success in business wasn't just about providing a service or product. It was about controlling an entire market. And that's exactly what he did with Standard Oil. Standard Oil wasn't just another oil company. It was a testament to Rockefeller's ability to create a monopoly, controlling nearly 90% of the U.S. oil market at its peak. But his influence went far beyond drilling for oil. Rockefeller understood the deeper mechanics of the financial system. He realized that the true power didn't lie in producing goods. It lay in controlling the money and the institutions that could move it. Rockefeller's banking blueprint. By 1913, Rockefeller had already established himself as an undeniable force in American business. His wealth was beyond measure, and his influence reached into every corner of the economy. But what many don't realize is that Rockefeller didn't stop with oil. He turned his attention to the financial system, creating a blueprint that would change the way America and the world would view banking and business for generations. At the core of this blueprint was the strategic manipulation of capital. Rockefeller's control over Standard Oil gave him enormous financial leverage, and with that power, he was able to influence banks, financiers, and markets across the globe. He understood that banking wasn't just about lending money. It was about controlling the flow of money. And with that control came the power to influence industries, shape policies, and dictate the terms of business across multiple sectors. The Rockefeller blueprint wasn't about simple wealth accumulation. It was about shaping the financial system into a tool that could be used to manipulate entire markets. By aligning himself with financial giants like J.P. Morgan, Rockefeller was able to position himself as not just a business leader, but as a financial strategist with unparalleled influence. J.P. Morgan and Rockefeller, a strategic partnership. In many ways, the partnership between Rockefeller and J.P. Morgan was inevitable. Morgan, a towering figure in the banking world, recognized the same power in finance that Rockefeller did. Together, they formed a symbiotic relationship. Rockefeller brought the wealth, and Morgan brought the financial institutions that could facilitate and grow that wealth. Their combined efforts laid the foundation for a financial system that was built on consolidation, control, and the steady accumulation of resources. This partnership set the stage for what would come next in the financial world. Rockefeller's model, one that leveraged banking power, strategic investments, and market control, would serve as the blueprint for future generations of financiers, including those who would follow in the footsteps of J.P. Morgan. By 1913, this power structure was firmly in place, and the financial system had become an intricate web connecting powerful men, institutions, and nations. The blueprint Rockefeller laid out wasn't just about creating wealth. It was about consolidating that wealth and turning it into a system that could shape the future of finance. The lasting impact of Rockefeller's influence. As the years went by, the influence of Rockefeller's blueprint continued to spread throughout the financial system. The strategies he put in place would be replicated by others, ensuring that the world would remain in the hands of a select few. But it wasn't just about wealth, it was about control. Rockefeller had shown the world that financial power wasn't just about possessing resources. It was about controlling the means by which those resources were moved and allocated. In the early 20th century, as the foundations of American wealth and power were being reshaped by giants like John D. Rockefeller, another figure was rising to prominence in the financial world, JPMorgan. Known for his brilliance in banking and his ability to control vast amounts of capital, Morgan's legacy was intertwined with the rise of corporate finance, just as Rockefeller's had been with the rise of monopolies. But it wasn't just their business strategies that aligned. It was their shared vision for the future of finance, one where the power to control industries was not just limited to production but extended to entire markets, including metals like silver. J.P. Morgan, a financial architect. J.P. Morgan, born into a prominent banking family, quickly made a name for himself as one of the most powerful men in American finance. Unlike Rockefeller, whose wealth was based on dominating oil, Morgan's wealth was derived from his unparalleled ability to consolidate financial institutions, extend credit, and control the flow of money across industries. Morgan had a unique talent for seeing opportunities in places others couldn't. He wasn't just a banker. He was a financial architect, building structures that allowed for the control of resources and the shaping of entire industries. By the time Morgan had established himself as the leading financier of the day, his influence was undeniable. His ability to orchestrate mergers, save failing companies, and manipulate the flow of capital made him the go-to man for financial solutions. While Rockefeller was shaping the oil industry, Morgan was positioning himself as the gatekeeper of finance, controlling access to credit, banking, and investment, ultimately consolidating much of the power into his own hands. J.P. Morgan's silver play, a strategic opportunity. As powerful as Morgan was, his ambitions extended beyond merely controlling financial institutions. He saw the potential in silver, a precious metal that had historically been used as currency and was integral to the global economy. By 1913, the silver market was in a state of flux. The world was still recovering from financial instability and the devaluation of silver, which had caused the metal's price to fluctuate wildly. In the midst of this volatility, Morgan saw an opportunity not just to profit, but to wield power over a critical commodity. But why silver? Unlike gold, which had already been firmly established as the cornerstone of global reserves, silver had yet to be fully embraced as a standard. However, it was still integral to many industries. Everything from manufacturing to the fledgling electronic and electrical industries that would go on to define the modern age. Silver was in demand, but its price was unstable. That instability created a market ripe for consolidation. Morgan knew that by accumulating vast quantities of silver, he could not only secure a major position in a vital industry, but also manipulate the price and supply of the metal itself. With the power of J.P. Morgan behind it, Morgan began to quietly buy up silver, securing enough of it to influence the market in a way that few could have predicted. How J.P. Morgan quietly cornered the market. J.P. Morgan's play to corner the silver market wasn't one that was made public. Far from the limelight, Morgan used his extensive network of financial contacts, bankers, and brokers to quietly acquire as much silver as he could. He leveraged the power of his bank, using a combination of financial instruments like futures contracts, loans, and stock purchases to stockpile silver in huge quantities. The strategy was not unlike the one Rockefeller had used in the oil industry decades before, buying up assets to consolidate control and eliminate competition. The key difference, however, was that silver was a commodity that was traded on the global market, making it more volatile and susceptible to manipulation. J.P. Morgan's move was calculated. By acquiring such a significant portion of the silver market, the bank was positioning itself as the de facto holder of the commodity. As Morgan's stockpiles grew, the price of silver began to climb, creating a scarcity that forced smaller players out of the market. It was the perfect storm for J.P. Morgan. They held enough silver to push the price higher while restricting supply, all without drawing the attention of regulators or competitors. They could control the price without ever appearing to do so. The ripple effect of J.P. Morgan's silver acquisition. As J.P. Morgan's influence over the silver market grew, the effects rippled through the broader economy. The price of silver, once relatively stable, began to climb rapidly. Smaller investors, those without the resources or financial backing to compete with Morgan's vast network, found themselves at a severe disadvantage. Some were forced to liquidate their holdings, while others were entirely wiped out. But the impact didn't stop at the individual investors. The silver market, which had once been seen as a safe investment, became increasingly volatile. Businesses that relied on silver for manufacturing found their costs rising, while countries that held large reserves of the metal saw their wealth eroded by the sudden price hikes. J.P. Morgan's control of silver created an environment of instability, an environment where the bank had the power to dictate terms to governments, companies, and individuals alike. The connection to Rockefeller's legacy. J.P. Morgan's acquisition of silver wasn't just a financial maneuver. It was a direct extension of the principles laid out by Rockefeller decades earlier. Just as Rockefeller had used his dominance in the oil industry to manipulate prices and eliminate competition, Morgan was now using his position in the financial system to control a vital commodity. Both men understood that true power didn't come from owning an asset. It came from controlling the flow of that asset, creating scarcity, and manipulating supply to their advantage. In the heart of the early 20th century, the world of finance was evolving at a rapid pace, and a new era of market manipulation was emerging. At the forefront of this transformation were figures like John D. Rockefeller and J.P. Morgan, men who understood that wealth and power could be not only acquired but engineered. But how exactly does one corner a market? And why did J.P. Morgan, armed with the financial infrastructure Rockefeller had helped lay, choose silver as the battleground? The answer lies in the mechanisms of financial leverage and strategic manipulation. What J.P. Morgan was about to do in the silver market wasn't just an exercise in accumulation. It was a calculated attempt to change the very rules of the game. By understanding these mechanisms, we can begin to see how powerful financial institutions can reshape entire markets and, in some cases, entire economies. What does it mean to corner a market? To understand J.P. Morgan's strategy, it's crucial to first define what it means to corner a market. In essence, cornering a market involves gaining control over a significant portion of a commodity or asset to the point where the supply is so limited that the price can be manipulated. The goal is to create an artificial scarcity, something that drives the price upward, often well beyond its natural market value. Those who hold the majority of the commodity can dictate the terms of trade, setting prices, and controlling the flow of goods in and out of the market. Market cornering isn't just a speculative play. It's an attempt to create a financial monopoly. When an entity can control the supply of a resource, they can demand higher prices, force competitors to the sidelines, and manipulate the flow of capital. For J.P. Morgan, the silver market was the perfect opportunity to execute this strategy. The role of financial leverage in market manipulation. J.P. Morgan, like Rockefeller before him, understood the immense power of financial leverage. Leverage allows an investor to control a much larger position in the market than their capital alone would permit. Through loans, margin trading, and futures contracts, an investor can amplify their financial influence, buying up significant amounts of an asset without using their full resources. This strategy can escalate profits, but it also escalates risk. Morgan's team used these very tools to gradually accumulate silver without outright purchasing it in large volumes. Futures contracts, for example, allowed them to bet on the future price of silver, committing to buy the metal at today's prices, while positioning themselves to take possession of it later, at a time when they would already hold a commanding share of the market. The key was not to draw attention. By using futures and options, J.P. Morgan could control the market without having to show its hand. This financial manipulation was subtle, yet extremely powerful. With leverage, J.P. Morgan could control more silver than they could afford outright, all while keeping their position hidden. The more they accumulated, the more the price of silver began to rise. As the price rose, the market took notice. But by then, JP Morgan's position was so entrenched that it became nearly impossible for anyone else to enter the market without risking massive financial loss. The strategic use of futures contracts and loans. One of the most powerful tools in JP Morgan's arsenal was the use of futures contracts. These contracts allowed them to lock in prices for silver months, even years, in advance. By securing large volumes of silver at today's prices, they could then sell those contracts to other investors, creating a secondary market in which they controlled the majority of supply. The result was a self-perpetuating cycle in which the price of silver increased, not because of natural demand, but because of artificial scarcity driven by JP Morgan's dominance. But futures contracts were just one part of the strategy. JP Morgan also employed loans and other forms of credit to acquire silver. The bank's enormous influence over the financial system meant it could borrow money at favorable rates, further amplifying its ability to buy up assets without using its own capital. With access to unlimited credit, JP Morgan could continue buying silver, knowing full well that they could leverage the financial system to finance their acquisitions. This made them an even more formidable player, as their ability to sustain purchases didn't rely on immediate cash flow or asset sales. In many ways, JP Morgan was using the financial system itself as a weapon. By borrowing against its position, leveraging credit, and manipulating the silver futures market, the bank was not just buying silver. It was changing the very structure of the market in its favor. Other market participants found themselves at a distinct disadvantage, unable to compete with the vast financial resources and strategic leverage that JP Morgan possessed, creating the illusion of demand. JP Morgan's silver strategy wasn't just about acquiring silver. It was about creating an illusion of demand. By gradually increasing its stockpile, Morgan caused silver prices to rise, which in turn drew more investors into the market. As the price increased, more people began to buy silver, assuming that the demand was naturally rising. The public and market participants alike were led to believe that silver was experiencing an organic surge in demand. The more people bought into the narrative of rising demand, the higher the price climbed. The rush of new investors only helped JP Morgan further tighten its grip on the market. Morgan had created a cycle where rising prices led to more purchases, which in turn pushed prices even higher. However, behind this illusion of a thriving market, JP Morgan controlled the majority of the metal, ensuring that they could dictate the terms of trade at every level. This manipulation was not just a short-term play. It was a long-term strategy that would enable JP Morgan to control the market for as long as they could maintain their position. The silver market, once a free market driven by supply and demand, had now become a system in which JP Morgan could create and control both supply and demand. It was the perfect financial strategy, one that capitalized on the volatility of markets and the public's belief in natural market forces. The hidden costs of market manipulation. While JP Morgan's manipulation of the silver market may have been highly profitable for the bank, the hidden costs of such actions were far-reaching. The immediate effects were felt by smaller investors who found themselves priced out of the market. Many went bankrupt or saw their investments evaporate as they tried to keep up with the rising prices. But the long-term consequences were even more profound. The instability that Morgan's cornering of the silver market caused was felt throughout the broader economy. The price of silver became unpredictable, creating a ripple effect that impacted industries relying on silver as a raw material. Manufacturers faced rising costs, and investors in silver saw their portfolios fluctuate wildly. The manipulative practices that JP Morgan employed to dominate the silver market left a legacy of distrust in the financial system, one that would influence market regulation and investor behavior for years to come. When JP Morgan successfully cornered the silver market in 1913, it wasn't just a victory for the banking titan. It was a defining moment in the history of modern finance. While the silver market manipulation may have seemed like a carefully orchestrated play by one of the most powerful financial institutions of the time, the consequences of that strategy rippled through the broader economic landscape in ways that would affect the global economy for decades to come. More importantly, it created a framework for how market manipulation could impact not just individual industries, but entire systems of global finance. The silver cornering saga didn't just affect silver itself. It left a trail of economic instability, led to the creation of regulatory measures, and set the stage for the kind of financial risks that businessmen and entrepreneurs today still navigate. To understand how these events shaped the world of business and finance, one must first look beyond the immediate aftermath to the broader economic ramifications that still echo today. Short-term economic impact, the immediate aftershock. The immediate consequences of JP Morgan's cornering of the silver market were felt quickly, but in ways that were difficult for many to fully comprehend at the time. As JP Morgan quietly amassed silver, the price of the metal began to climb. Silver, which had once been considered a stable commodity, suddenly saw its value fluctuate wildly. The volatility of silver's price created chaos in the market. Small investors and manufacturers who relied on the metal found themselves unable to keep up with rising prices. Silver users in industries such as photography and electronics faced skyrocketing costs, which forced them to either cut back on production or pass along the increased costs to consumers. This chain reaction contributed to a ripple effect throughout the economy, where businesses faced unexpected cost increases, reduced margins, and, in some cases, bankruptcy. For the general public, the instability in the silver market created a sense of uncertainty. As the price of silver soared, it was no longer just a matter of economic theory. The cost of goods and services that relied on silver started rising as well, making everyday commodities more expensive. The public's trust in the markets, already shaky from earlier financial crises, began to erode. The silver crisis wasn't just a financial story, it was a crisis of confidence. Long-term consequences for the financial system. The long-term ramifications of JP Morgan's silver cornering strategy were more profound and enduring. The most notable outcome was the acceleration of public and governmental distrust in unregulated financial practices. Before 1913, the financial system in the United States was largely free from the kind of oversight that would later come to define modern financial markets. However, as the silver market crisis unfolded, it became clear that financial giants like JP Morgan had the power to manipulate entire markets without any regard for the consequences on the public or the economy. This period marked a significant shift toward the creation of formal financial regulations. The Sherman Antitrust Act, passed in 1890, had already laid the groundwork for antitrust laws aimed at preventing monopolies. However, the silver crisis revealed that the laws weren't sufficient to prevent the kind of financial manipulation that JP Morgan had engaged in. As the repercussions of the silver cornering reached Washington, the calls for stronger oversight and the establishment of regulatory bodies grew louder. By the time the Federal Reserve System was established in 1913, one of its core goals was to prevent the kinds of market manipulations that had taken place in the silver market. While the Federal Reserve's creation was not directly linked to JP Morgan's actions, the silver crisis highlighted the need for more centralized control over monetary policy. Financial institutions now had to contend with new regulations designed to curb the risk of such massive market manipulation. The ripple effect from JP Morgan's silver cornering wasn't limited to silver or even the broader commodity markets. It impacted the way banks and financial institutions operated at the highest levels. It forced a rethinking of financial practices and highlighted the dangers of too much control concentrated in the hands of a few powerful institutions. It became evident that unchecked power in finance had the potential to destabilize entire economies, just as it had done with silver. Lessons for modern businessmen and entrepreneurs. So, what lessons can modern businessmen and aspiring entrepreneurs take from JP Morgan's manipulation of the silver market? First and foremost, the incident serves as a powerful warning about the potential consequences of unchecked power in financial markets. While it may have seemed like a brilliant strategy for Morgan at the time, the long-term impact was far from beneficial for the wider economy. The silver crisis exposed how financial manipulation, particularly when it comes to vital commodities, can have unforeseen consequences. Small businesses, investors, and consumers all felt the negative effects of price manipulation, illustrating just how vulnerable markets are to the whims of a few powerful players. For modern entrepreneurs, the lesson is clear. Success in business should not be built on manipulating markets or creating artificial scarcity. In the long run, such strategies tend to backfire, undermining trust and causing harm to the very economy that supports growth. Moreover, the financial world of today is far more regulated than it was in the early 1900s. But that doesn't mean there aren't still opportunities for powerful institutions to manipulate markets, albeit in more subtle and sophisticated ways. Modern entrepreneurs must be aware of the risks involved in financial leverage, speculation, and market manipulation. While these tools can help propel business growth, they also come with the potential to destabilize industries and economies if used recklessly. The role of financial regulation, a direct response to market manipulation. The events surrounding the silver crisis also played a crucial role in the establishment of financial regulation as we know it today. The rise of regulatory bodies like the U.S. Securities and Exchange Commission (SEC) in the 1930s and the broader implementation of financial oversight was in many ways a direct response to the manipulation of markets by powerful figures like JPMorgan. The creation of these bodies helped to create a more level playing field, ensuring that no single entity could dominate entire markets in the way Morgan had done with silver. But this also marked a shift in the way business was conducted. Financial institutions had to operate within a system of checks and balances, where transparency, accountability, and fair competition became fundamental principles of modern business. For today's businessmen, understanding the historical origins of financial regulation is essential. The framework we operate in now has been shaped by lessons learned from the excesses of the early 20th century. The world of finance is far more complex than it was a century ago, and navigating it requires a thorough understanding of the regulatory environment. While it may seem like a burden at times, the system of regulation exists to protect not just investors, but the broader economy from the risks of market manipulation. Conclusion: a shifting financial landscape. J.P. Morgan's cornering of the silver market in 1913 was a wake-up call for the financial world. It exposed the dangers of unchecked market manipulation, the fragility of industries reliant on commodities, and the necessity of strong regulatory oversight. While it may have been a victory for Morgan in the short term, the long-term consequences were far-reaching, reshaping the financial system and creating a legacy of financial regulation that would continue to evolve throughout the 20th century. In the wake of the silver crisis of 1913, a new understanding emerged about the fragility and complexity of global finance. The consequences of J.P. Morgan's market manipulation not only reshaped entire industries, but also ignited a broader conversation about how financial systems should operate in the modern world. For entrepreneurs and businessmen, the fallout from this historical moment presents a critical set of lessons. The question is no longer simply about making money. It's about navigating an increasingly complex and volatile financial landscape where the stakes have never been higher. In this final chapter, we examine how modern entrepreneurs can learn from the past and build sustainable business models in a world where financial manipulation, while regulated, still lurks in the shadows. More importantly, we look at how entrepreneurs can prepare for the volatile, ever-changing markets and risk management environments they will face, and how they can safeguard their business in an uncertain future. One of the first lessons from the silver crisis is the complex nature of financial power. When J.P. Morgan cornered the silver market, he didn't just acquire silver. He created a financial system that was, in effect, built to serve his interests. But what allowed him to do this? It wasn't just wealth. It was access to financial tools, leverage, and an understanding of the structures that govern the movement of capital. He manipulated the system from within. For today's aspiring entrepreneurs, this is a crucial lesson. Financial power is not just about generating revenue or building assets. It's about understanding the system that controls money. It's about recognizing how markets work, how capital flows, and how financial tools, whether they are loans, futures contracts, or even regulations, can be leveraged to your advantage. A successful entrepreneur must learn how to navigate these systems not only to grow their own businesses, but also to understand how to protect them from larger economic forces. But even more than that, modern entrepreneurs must also recognize the risks inherent in such systems. In an age where wealth is often concentrated in the hands of a few, the possibility of financial manipulation remains, even in highly regulated markets. Entrepreneurs must ask themselves how they can avoid these pitfalls. What steps can they take to ensure that their own actions do not unwittingly destabilize their business or the market in which they operate? Building sustainable business models in a world of uncertainty. JP Morgan's success in cornering the silver market wasn't just a demonstration of financial brilliance. It was also a warning. It showed how businesses that rely on manipulation or speculative financial strategies can achieve short-term success, but they can also create long-term instability. It's easy to look at the meteoric rise of financial giants in history and wonder if emulating their strategies is the key to business success. However, it's crucial to understand that the best path forward is often not the most aggressive or manipulative one. Sustainable business models are built on the foundation of ethics, transparency, and long-term growth. Entrepreneurs today must learn from the lessons of financial crises like the silver panic. Short-term gains built on market manipulation are not sustainable. To thrive in the modern financial system, businesses must focus on innovation, quality, and delivering real value to customers, rather than relying on market gamesmanship. In a world where economic uncertainty is a constant, whether it's inflation, geopolitical tensions, or market disruptions, the need for sustainable and adaptable business models has never been more crucial. Entrepreneurs must be prepared for economic volatility by building businesses that can weather the storm. This means diversifying income streams, fostering strong relationships with customers and suppliers, and preparing for potential financial downturns. The silver market of 1913 reminds us that unexpected volatility can cripple businesses that are too reliant on a single commodity or speculative play. Risk management and the importance of ethical decision-making. In the modern business world, managing risk is a key part of ensuring long-term success. But risk management isn't just about diversifying investments or hedging against market changes. It's also about making ethical decisions that safeguard the business, the market, and the reputation of the entrepreneur. The story of JP Morgan's cornering of the silver market shows us what can happen when financial power is unchecked. While the manipulation of silver prices was ultimately beneficial to JP Morgan in the short term, it came with significant long-term consequences: a tarnished reputation, a loss of public trust, and growing regulatory scrutiny. Ethical decision-making is crucial for today's entrepreneurs. The financial world, though highly regulated, remains prone to manipulation, speculation, and risk. Entrepreneurs need to make decisions that not only protect their business, but also contribute positively to the economy and society. They must be aware that the lines between ethical and unethical business practices are often blurred in the pursuit of profit. It's important to remember that business success should not come at the expense of integrity. For modern entrepreneurs, building a reputation for honesty, transparency, and responsibility can be just as important as building a profitable business. A strong ethical foundation helps businesses attract customers, partners, and investors who share similar values, creating an environment where growth is based on mutual trust, not manipulation. Preparing for financial instability and market disruptions. While the financial system today is more regulated than it was during the early 1900s, it's still susceptible to sudden disruptions. Geopolitical events, market crashes, inflationary cycles, and financial crises can create sudden and significant changes in the business landscape. Entrepreneurs must be prepared to face such disruptions head-on. The silver market crisis of 1913 didn't just demonstrate the power of one financial institution to manipulate a market. It also showed how market disruptions can create cascading effects that ripple through entire industries. For today's entrepreneur, this is a crucial lesson. Businesses must be prepared for volatility, not just by securing their financial position, but by being adaptable and resilient in the face of adversity. Entrepreneurs should keep an eye on macroeconomic trends and be ready to pivot when necessary. In the modern era, technology offers entrepreneurs a greater ability to adapt and survive market disruptions. Leveraging data analytics, predictive tools, and financial modeling can help entrepreneurs prepare for unexpected shifts. Being proactive rather than reactive can provide a crucial competitive advantage in times of uncertainty. The story of JP Morgan's silver cornering and the legacy of John D. Rockefeller's financial blueprint serves as a powerful reminder of the intricate relationship between business and finance. While the manipulation of markets may offer short-term rewards, the long-term consequences can be severe. both for the economy and for the business itself. Modern entrepreneurs must learn to navigate a complex financial landscape that is fraught with risks and opportunities.